Hello, ladies and gentlemen. Welcome to SPL Tutorials. My name is CPA Samson Okari. And in this session, I'm going to take us through a summary of International Financial Reporting Standards, or IFRS standards that are in issue. But I'll start with what the body that develops international accounting standards is, or IFRSs, and what its role is. And then we'll look at a summary of all the IFRS standards and international accounting standards, or IASs, that are currently in issue as of August 2025. Now, the beginning conversation is on what are the International Financial Reporting Standards, or IFRSs. These are a globally recognized set of standards developed by the International Accounting Standards Board, or IASB in short, for the preparation of financial statements by business entities. The IFRSs standards prescribe, number one, the items that should be recognized as assets, as liabilities, as income and expenses. Number two, how to measure the items. In other words, how much should be recognized in the financial statements, how to present them in a set of financial statements. For example, where should the assets and liabilities be on the statement of financial position? What about the incomes and expenses? What are going to be revenues? What is going to be direct cost? What is going to be presented as operating costs or administrative costs, general and admin costs, and so forth. And lastly, the International Financial Reporting Standards prescribe related disclosure about the items. The disclosures are the more detailed information that needs to be provided so that the users of the financial statements or the annual report can be able to understand the financial statements. For example, if you have particular assets that have been used as collateral for a loan, that disclosure needs to come out that included in the non-current assets or fixed assets section, asset worth this much that have been used to secure a loan. Now, we mentioned that IFRSs are developed by the International Accounting Standards Board, or IASB, and this is an independent private sector, not-for-profit organization, which was formed in 2001 to replace or to succeed its predecessor, that is International Accounting Standards Committee, IASC. The entity is London-based, but it has a global mission. The vision of the board, or the vision of the IASB, is to develop, in the public interest, a single set of high quality, understandable, and enforceable global accounting standards that require high quality, transparent, and comparable information in financial statements and other financial information to help participants in the world's capital markets and other users make informed economic decisions. So their role is to develop international financial reporting standards out of public interest, so that then we can have the measurement, the presentation and disclosure that we talked about, and have transparent and comparable financial information in the financial statements and other financial information. Why? So that we can help the participants across the world and other users as well to make informed economic decisions. This vision has been publicly supported by many international organizations, which include the G20, the World Bank, the IMF, the Basel Committee, the International Federation of Accountants, and the Council of the European Union. Now, let's then move to the main agenda for this session, the summary of international financial reporting standards in issue. And it should be noted that when we talk about IFRSs or international financial reporting standards, we are talking of both the international financial reporting standards, IFRS, and the international accounting standards that are currently in issue, IAS. Now, there are currently 19 IFRS standards and 41 IASs. And the first IFRS is IFRS 1, which deals with the first-time adoption of IFRS standards. The standard was first issued in 2003 and was effective from January 2004. So any entity that wants to adopt IFRS for the first time, be it that it has been using generally accepted accounting principles or country-specific accounting standards, for example, Egyptian accounting standards or Angolan GAAPs, that entity must use IFRS 1 for guidance on how to adopt the IFRS standards. IFRS 2 deals with share-based payments and was issued in 2004 with an effective date of January 2005. Now, this standard deals with any compensation in form of shares. It can be equity settled or cash settled share-based payments, and it gives guidance on how to account for such share-based payments, be it employee share option plans or ESOPs, as you can call them. IFRS 3 deals with business combinations, and this is the standard that gives guidance on when businesses merge or another entity acquires another. And it was issued in 2004 with an effective date of March 2004. The fourth standard, which is IFRS 4, is currently replaced by IFRS 17, but nevertheless, it dealt with insurance contracts. IFRS 5 deals with an non-current asset held for sale and discontinued operations. The standard was issued in 2004 with an effective date of January 2005. So if an entity has designated some assets as held for sale, that means that IFRS 5 comes in. The assets need to be transferred from the fixed assets category, and they need now to be accounted for under the non-current assets held for sale category. And if they have any discontinued operations, like a branch that is being closed down or a subsidiary that is being closed down, this now will sit in the discontinued operations category. IFRS 6 deals with exploration for and evaluation of mineral resources. This is a special activity, and therefore an entity that is in the exploration or evaluation of mineral resources needs to account for its assets and other resources using IFRS 6. The standard was issued in 2004 and was effective from January 2005 and 6. Sorry. The next standard is IFRS 7, which deals with financial instrument disclosures. And at this point, I need to mention that there are 3 standards that deal with financial instruments. There is IFRS 7 dealing with financial instrument disclosures. There is IFRS 9 dealing with financial instruments. And then there is IAS 32 dealing with presentation of financial instruments. So IFRS 9 deals with the accounting for financial instruments. But we are going to, again, have a look at them when we get to where they are. So IFRS 7 deals with disclosures related to financial instruments. It was issued in 2005 with an effective date of January 2007. IFRS 8 deals with operating segments, and this was a standard that was issued in 2006 with an effective date of January 2009. The standard specifically applies to listed entities and gives guidance on operating segments, reportable segments, and how to go about coming up with the segments. IFRS 9, as we said earlier, deals with financial instruments, the accounting for financial instruments, and it replaced IAS 39, which also dealt with financial instruments. But now there's a lot of improvement in IFRS 9 financial instruments because it has changed the classification of financial instruments. We previously had 4 classification categories under IAS 39. held to maturity, you can call it HTM, fair value through profit or loss, or FVTPL. There was available for sale, AFS, and finally, there was loans and receivables. Now, under IFRS 9, financial instruments are classified based on their business model, which is either holding to collect or holding to collect and sell, and their contractual characteristics. And in this category, then, we have three classifications. Financial instruments can be classified either at fair value through profit or loss, fair value through other comprehensive income, or at amortized cost. Now, the standard was issued in 2014 and was effective from January 2018. And this standard brings about some significant changes in terms of provisioning for bad and doubtful debts, in that IFRS 39 required that we prepare or make a provision for bad and doubtful debts when they have been incurred. We can call it the incurred model. But now under IFRS 9, we have what we call the expected credit loss model, ECL model. IFRS 10 deals with consolidated financial instruments, and this is the standard that guides on how to go about preparing the consolidation schedule, what needs to be eliminated in terms of the intercompany transactions, and then also provides some light on what are those entities that may be, we can call them investment entities, and therefore may not need to consolidate their financial statements. The standard was issued in 2011 and was effective from January 2013. So sorry for the name of the standard. It's consolidated financial statements, not financial instruments. IFRS 11 deals with joint arrangements, joint ventures, joint transactions, or whenever entities decide to come together jointly to address a particular project. The standard was issued in 2011 and was effective from January 2013. IFRS 12 deals with disclosure of interest in other entities, be it joint ventures, be it special purpose vehicles, be it subsidiaries. Entities need to disclose their interest in other entities using IFRS 12 guidance. Now, this standard was issued in 2011 and was effective again from 1st of January 2013. IFRS 13 is a very important standard when it comes to fair value measurement. So the standard deals with fair value measurement, and this is the single guidance for how to go about measuring the fair value of any assets or liabilities as guided by specific standards. For example, IFRS 9, we said requires that financial instrument be measured at fair value through profit or loss, or fair value through other comprehensive income. That measurement of fair value needs to be under the guidance of IFRS 13. IAS 41 requires that biological assets be measured at the fair value less cost to sell. So that fair value needs to be measured using IFRS 13 requirements. IAS 40 requires that an entity determines or decides whether they are going to measure their investment properties either at cost or fair value. So whenever they decide that they are going to measure them at fair value, then IFRS 13 comes in. So the standard was issued in 2011 and was effective from January 2013. IFRS 14 deals with the regulatory deferral accounts, and this standard was issued in 2014 with an effective date of January 2016. IFRS 15 deals with the revenue from contract with customers. This is a standard that replaced two standards, IAS 18 revenue and IAS 11 construction contracts. The standard was issued in 2014 with an effective date of January 2018. The standard brings about some significant changes in terms of how revenue should be recognized by specifically bringing about a 5-step approach in recognizing revenue. Number 1, you identify the contract with the customer. Number 2, you determine the separate performance obligations in that contract. Then number 3, or step 3, you determine the transaction price. Step number 4, you allocate the transaction price to the performance obligations that you identified in step 2. And then lastly, you recognize the revenue as or when the performance obligations are fulfilled or satisfied. That means that revenue will be recognized either at a point in time or over a period of time. We shall have a candid and more detailed discussion when we are going to look at IFRS 15, and you can always look out on our channel. You may find that we have uploaded IFRS 15 detailed discussion. IFRS 16 deals with the leases and was issued in 2016 with an effective date of January 2019. The standard replaced IAS 17, which dealt with leases, whereby under IAS 17, we used to classify leases as either operating or finance leases. Now, under IFRS 16, every lessee must recognize a right of use asset, which is the right to use an underlying asset, and a lease liability. In the P&L, they have to recognize interest on lease liabilities and the depreciation or amortization of the right of use asset. IFRS 17 deals with insurance contracts. This is the first international standard dealing with insurance contracts, because IFRS 4 can be viewed to have been an interim standard. The standard was issued in 2017 with an effective date of January 2022, which was later moved to January 2023. IFRS 18 is a new standard that deals with presentation and disclosure in financial statements, which was issued in 2024 and shall be effective from 1st of January 2027. The standard brings about some significant changes on presentation and disclosure, especially on the structure of the statement of profit or loss and other comprehensive income, in that now we are going to have revenue and expenses being classified into 5 categories: operating category, investment category, financing category, income taxes category, and the discontinued operations category. We shall have also an upload on IFRS 18, having a detailed discussion on the impact of the same and what are the specific requirements of the new standard. IFRS 19 is also a new standard dealing with the subsidiaries without public accountability. This standard was issued in 2024 and shall be effective from January 2027. The standard just gives guidance on some reduced requirements in terms of the disclosures that need to be made by subsidiaries that do not have public accountability. And the standard gives detailed guidance on which entities qualify to be subsidiaries without public accountability. So that's all for the IFRSs. Now let's briefly look at the international accounting standards that are currently in issue. We have IAS 1, presentation of financial statements, which was issued in 2003 and was effective from January 2005. The standard makes or provides guidance on how to present financial statements. It's the one that talks about the minimum contents of each of the 5 elements of financial statements. And it talks about the statement of financial position, statement of profit or loss and other comprehensive income, statement of changes in equity, the statement of changes, the statement of cash flows, and a summary of accounting policies and explanatory notes, and what each of these should contain. As we mentioned, IAS 1 is set to be replaced by IFRS 18 in 2027. IAS 2 deals with inventories. The standard was issued in 2003 and was effective from 1st of January 2005. The standard gives guidance on how to account for inventories. And specifically, the standard states that inventories should be measured at the lower of cost or net realizable value. We'll have some uploads on IAS 2 as well in terms of our discussions around inventories and how to account for them. IS7 is another standard that is currently in issue, which deals with the statement of cash flows. The standard was issued in 2007 with an effective date of January 2010. This standard talks about the presentation of the statement of cash flows, and specifically it guides that the statement of cash flows can be prepared using the indirect method or the direct method. IS8 deals with accounting policies, changes in accounting estimates, and errors. The standard was issued in 2003 and was effective from 1st of January 2005. So the accounting policies are those choices that an entity makes in terms of how to account for various items that we mentioned. For example, we said that an entity may make an accounting policy choice under IS 40 to measure their investment properties either at cost or at fair value. That is an accounting policy. Now, whenever there is a change in accounting policy, an entity needs to bring that out using IS 80 requirements. And also, if there are any changes in accounting estimates and errors, we need to account for them using IS 8. Briefly, because we shall have an upload on IS 8 detailed in terms of how to account for accounting policy changes, estimates, and errors. I need to mention that if there is a change in accounting policy, it needs to be applied retrospectively, meaning as though the standard was in use in previous periods. If it's a change in accounting estimate, that needs to be applied prospectively, meaning we apply it from that date going forward. Again, if there are errors that need to be corrected in the financial statements, those errors need to be corrected retrospectively. And in fact, we need to have a third balance sheet, and also we need to rename the prior year financial statements and call them restated. We have, or we shall have, a detailed IS 8 discussion uploaded on our platform. And if you need specific training on IS 8 or any other standard, you can reach out to us. IS 10 deals with events after the reporting period, or we can call them post-balance sheet events. The standard was issued in 2003 with an effective date of January 2005. The standard talks about two types of post-balance sheet events or events after the reporting period: adjusting events and non-adjusting events. Adjusting events are those events that require that the financial statements be adjusted, as the name suggests. For example, if our debtor becomes bankrupt at the year end, we then need to go back to the year end and make a provision for bad and doubtful debt for that particular debtor. If a case that has been in court on an employee that claimed to have been unfairly dismissed crystallizes after the year end, it means that we need to have made a contingent liability or made a provision for contingent liability at the year end. So we need to go back to the year end and make a provision for contingent liabilities. Non-adjusting events, on the other hand, are those events that do not need us to adjust the financial statements, but we need to mention them or make disclosures about them. For example, if a fire razed down one of the warehouses after the year end, that means this is an adjusting event because at the year end, the warehouse was intact and in good condition. IS 11 dealt with construction contracts, and as we mentioned, it was superseded by IFRS 15. IS 12, income taxes, is a standard that addresses matters related to income taxes, and it talks about deferred taxes and current taxes. The standard was issued in 2017 and was effective from January 2019. IS 16 deals with property, plant, and equipment. This standard was issued in 2003 and was effective from January 2005. IS 17 dealt with leases, and we said it has been superseded by IFRS 16. IS 19 deals with employee benefits, and this is a standard that was issued in 2004 with an effective date of January 2006. Specifically, the standard talks about three classifications of employee benefits. There are those that we can call short-term employee benefits. We have got post-employment benefits, and we have termination benefits. And it gives guidance on how to account for each and every one of those categories. We said IS 18 was replaced by IFRS 15, so we don't need to belabor ourselves in discussing it. IS 20 deals with accounting for government grants and government assistance. This is a standard that was issued in 2008 with an effective date of January 2009. IS 21 deals with the effects of changes in foreign exchange rates. This standard was issued in 2003 with an effective date of January 2005. We have IS 23 dealing with borrowing costs, and this standard was issued in 2007 with an effective date of January 2009. The standard talks about qualifying costs which need to be capitalized, while the rest of the borrowing costs need to be expensed as incurred. IS 24 deals with the related party disclosures and was issued in 2003 with an effective date of January 2005. An entity needs to disclose related party balances, related party transactions, and what kind of relationship they have with the related parties. IS 26 deals with accounting and reporting by retirement benefit plans. The standard was issued in 1987 and was effective from January 1988. We have IS 27 dealing with separate financial statements, which was issued in 2003 with an effective date of January 2005. I've left out some other standards like IS 29 dealing with hyperinflationary economies, IS 32 dealing with the presentation of financial instruments, IS 33 dealing with earnings per share, IS 34 dealing with interim financial reports, IS 36 dealing with impairment of assets, whereby it requires that an asset must be carried no more than its recoverable amount. So an impairment loss needs to be accounted for whenever the carrying amount of an asset is less than the recoverable amount. So we reduce the carrying amount to the recoverable amount and expense that as an impairment loss. We have IS 37 dealing with provisions, contingent liabilities, and contingent assets. IS 38 dealing with intangible assets and criteria for recognition of the same. We said IS 39 was replaced by IFRS 9. We have IS 40 dealing with investment property, which we mentioned that it requires an entity to make a policy choice whether to account for the investment property at cost or at fair value. And lastly, we have IS 41 dealing with agriculture. The standard specifically requires that an entity measures biological assets, which are living plants and animals, at fair value, less cost to sell. The cost to sell would include commissions paid to sell the asset, transportation cost to take the asset to the market for sale, licenses and permits that need to be paid, and other costs that are attendant to or relate to selling the asset. It requires that a biological asset that is a perennial crop, for example, a coffee bush or a tea bush or an avocado tree that reaches maturity, that's the point of production, should be transferred to IS 16 and be measured as a property, plant, and equipment item under the class of bearer plants. So this is the summary of IFRS standards, because we said IFRSs and IASs together are called IFRS standards. And the aim was just to bring you up to speed on what are the standards that are in place, so that as you start your journey of becoming an IFRS expert, you first need to grasp or have it at the fingertips what the IFRSs and IAS standards are that are currently in issue. Thank you for listening in. Looking forward to you subscribing to our channel, and your comments on how we can improve. If you need tailored training or customized training for your team, we are a call away. You can see our contact on the shared screen, and reach out to us. So to that end, we thank you. Enjoy your morning, your evening, or afternoon, or even night. Thank you.